Hello, this is Richard Wilson, and today we have with us Bradley Fisher of Featherstone Holdings. Bradley has over 28 years of experience and over 9 years specifically of working with family offices directly. And we really invited him to do this recorded phone interview today for a few reasons. The first reason is to kind of dig into private equity industry information, best practices, standards, how private equity kind of works, and then also look a little bit about how wealth management firms and family offices and other types of investors use private equity and why they like to invest in private equity, so that people listening to this, if they feel like private equity is somewhat of a blind spot on their radar, either as a career professional or investor, I think this will really help. So, Brad, thanks for joining us here on the phone today.
My pleasure, Richard. Thank you for having me.
Great. So, let's start out with just some of the really basics. Can you explain, how private equity investments in general are kind of structured, or kind of how the business model works at a really high level?
Well, of course, there are two ways of approaching private equity. One is to invest in private equity funds, and one is to invest in direct operating businesses, either as an angel investor or as someone more involved in active management of the company. So we'll take a look briefly at both of those. Before we do that, I think we should calibrate our definition of private equity. When I speak of private equity, and when our firm Featherstone Holdings talks about private equity, we mean the full spectrum from very early stage angel investing through the venture capital space and into the buyout space, and finally mezzanine finance and project finance at the far end of the spectrum of the most developed businesses. So we're really looking at venture capital, buyout, and project finance. Does that make sense, Richard?
Yes, I think that makes sense. And from the perspective of people who are taking some of our training programs, I think probably 80% of them look at private equity as investing within private equity funds of many different types. There are some people who directly invest in private companies, and they kind of act as if they're their own, private equity fund in a way. But for this interview, maybe just because of time constraints, maybe we can zero in within the overall private equity niche to that side of things where people are investing in private equity funds, and somebody is out there and they're running a private equity fund and they're offering that to different types of investors. Does that make sense?
Yeah, sure,
Okay.
it does. What I'd like to do is just sort of focus for a second on the role of private equity in a family's portfolio, just to
Sure.
make sure that we're clear on that. And then certainly we can focus more on the fund side than on the direct investment side.
Sure.
So if you look at a family, especially what we call a multi-generational family, of course, all families by definition are multi-generational, but what we mean is family that has an ambition to stay together financially and in terms of the mission of the family, the organization of the family, across multiple generations. We've all heard the phrase that in America, shirt sleeves to shirt sleeves in 3 generations. The notion that grandpa and grandma have a business, they create some wealth, and then the second generation gets involved, and the third generation, and finally everybody has $12.50 left over from the initial wealth. We're not alone in America. In China, they say rice paddy to rice paddy in 3 generations, and in the Netherlands, they say clogs to clogs in 3 generations. So it's a natural dynamic that happens as the population of the family expands and the consumption of the family expands over time. The reason I go into that is because one of the things that helps families avoid that problem and extend their success together across more than just 2 or 3 generations is this close access to new wealth creation. Traditional assets, by which I mean stocks and bonds, fixed income and public equities, really they generate wealth as well, but they do that primarily through compounding and through the growth of the markets over time, beta, if you will. The role that private equity investing and also real estate investing play is more along the lines of creating new wealth through entrepreneurship and through judicious investing in private assets. And so that's what we're really focused on in this conversation, and what my firm is focused on is how do we get families better access to these private investments, both on the fund side and the direct side, in order to help them build wealth and, by the way, engagement from the younger generations. Does that make sense, Richard?
Yep, that makes sense.
So please go ahead with questions related to
Sure.
funds.
So could you explain a little bit about the fee structures within private equity funds? Because I think that many people, many investors are familiar with hedge fund fees and how those work, or at least a little bit more so, but private equity fees can be a little bit more confusing. Could you explain kind of how those work?
Yes, if you let's take the hedge fund fee case because it's simpler, and in many ways the private equity funds parallel those. The language is slightly different, but the idea is the same. So typically with a hedge fund, you'll have two types of fees, as you know, a management fee ranging usually from 1 to 2, sometimes up to 3.5%. I've heard some examples, but usually it's around 1 or 2%. And then what's called a performance fee, which enables the hedge fund partners to share. Often that's at 20%. That's sort of a typical norm, as you know, of the profits going forward. They'll also have what's called a high water mark, where the partnership or the general partners of the hedge fund won't make money if the profits drop below the initial point or the high level point that the investors enjoyed in the past. Well, in private equity, it's fairly similar. There is a management fee that's charged, and it too ranges usually from 1%, sometimes less, to 2%, sometimes 2.5%. I'll explain how that works in a minute. It's slightly different. And then there's what's called a carry, which is essentially a performance fee, and that's a share of the ownership of the underlying assets and the performance in those assets. So structurally, it's fairly similar. What you'll also often have in private equity and real estate investing is a hurdle rate, which doesn't generally apply in hedge funds as much, which means that there's a certain return. It's not guaranteed to the investors, but it's a rate. It's literally a hurdle that the partners of the private equity firm need to generate or need to overcome before they start to share in the profits. The carry will also range from 5 to 20% or more sometimes for these private equity firms, depending on the structure of the deal. And a hurdle rate could be anywhere from 5 to 10, 15%. Generally, it's probably between 8 and 12% hurdle rates. That means that the LPs, the limited partners, or the investors in that venture capital or buyout fund have to receive at least 8% return on their money, let's say, before the general partners of the investment fund start to share in the profits. Does that make sense, Richard?
Yeah, I think that's very helpful. That's what we are looking for. And when we started this interview, you talked about all the different types of private equity funds that can exist. Even when you narrow it down to, actual private equity funds that are kind of run as independent fund management operations and take outside investors. Could you maybe back up a step and kind of explain maybe the top 3 most popular types of private equity funds, so people listening to this about how the fees work and what types of investors they attract can kind of think in their head in terms of buckets of maybe the top 3 types of private equity funds that are out there in the industry?
Well, I'd say there are 2 primary types, and that are differentiated by the type investing that they do, and then there are stage differences, which I'll describe.
Okay.
And the 2 main categories are venture capital and what's called buyout. And within venture capital and within buyout, there's a range of the stages of development in the companies. And you can think of this as a spectrum. There's also what's called, at the end, the third category you may have been referring to are sort of ongoing what's called debt financing or growth capital that's applied to companies, mezzanine financing, ways of providing capital to firms that are much more developed. But if you look at the venture capital buyout spectrum, you start out at the very beginning with angel investing on the very early stage. So it's the kind of two guys in a garage concept where they've got an idea and maybe a couple potential customers and some technology, and people are coming to give them some money to bring that idea to market. Usually that on the angel side, that's done on a deal-by-deal basis, although now there are starting to be what's called super angels, which are actually creating venture capital funds with very early stage, making very small investments. The next stage in the venture capital spectrum is early stage investing, where the venture capital firm, and this is a grand tradition from many decades now, the venture capital firm will invest a small amount of money, meaning maybe a couple $100,000 up to a couple $1,000,000 to help an idea that's almost ready for the market really be turned into a business. The venture capital firm will typically create a fund and will typically put 20 to 30, I guess, maybe 10 to 30 investments ranging from, in that 500 to maybe $5 million, let's say, into these early stage companies with the hope that some small number of them will be very successful and a few of them will be moderately successful, and they know going into it that they're going to lose a few. Then the next side of venture capital is what's called growth stage financing. And these are companies that have technology in place, have products, they're out in the market, they have revenues, but they need now money to fuel the trajectory to real strong growth. So that's just a later stage. Similar portfolio strategies apply. And so the venture capital spectrum ranges from very early up through this growth phase. Then that's when buyout starts to kick in. It's a similar objective, but it's a different process. In buyout private equity funds, the idea is to literally often buy what's called controlling interests of the company, meaning we're going to find a company, we may be wanting to buy a profitable company with an intact management team and just make it grow faster and enhance the value somehow. Some firms will do what's called turnarounds, where they'll buy distressed companies that are in trouble and add a lot of value by literally turning that company around, making it profitable, making it succeed. Sometimes people will buy these companies so they can combine them with other companies and make a bigger whole, a holding company or a larger conglomeration of businesses. And then sometimes at the later stages, firms will buy large companies and break apart the individual parts and sell them or develop them and sort of disassemble them and make more money that way. So there's a whole spectrum in the buyout space of small to mid-cap companies where you're buying a controlling interest and hoping to build that company and sell it, all the way through large cap buyouts. Then these companies will do that. These firms will do that one company at a time, and sometimes they'll set up funds to do that with the fee structures that we described earlier. On the mezzanine finance and the project finance side, those are organizations or target companies that are usually much more developed, that just need ongoing financing to grow or to accomplish strategic objectives they may have in mind. And at those times, the firms involved will try to find debt financing for those companies or projects. Does that answer your question, Richard?
Yeah, no, it does, and it's kind of a bear of a question to answer. So thanks for tackling that, because the private equity industry does, it is so diverse compared to some other industries. I think it is a little bit hard to explain within one concise answer. So that's definitely helpful. Now, during the recent economic recession, there was a lot of talk about how people had capital calls they had to worry about when it comes to liquidity or the amount of cash they have on hand. Could you explain, what a capital call is and how that affects, the investor and what effect that has on their level of cash?
Sure. One of the characteristics of private equity investing, as opposed to hedge fund investing, is that the money you commit to the investment does not leave your account right away. With a hedge fund, if you commit to investing $1 million, then you sign the documents and you transfer $1 million immediately to the hedge fund manager, and they, quote unquote, put that money to work over a fairly short time period. That's not the way it generally works with private equity. What happens with private equity is if you commit, you sign the documents to the firm, you commit to $1 million investment, they're not going to start using that capital until they find underlying companies to invest in. It's called drawing down the capital commitment. They may draw down a little bit of the capital at the beginning in order to fund their operation, in order to pay those management fees that we talked about. And in fact, one thing I forgot to mention, by the way, is that often, and you have to be careful about this, often venture capital and buyout funds will charge this 1% or 2% management fee on committed capital, not just what's called capital, the capital that they're already using. So you just have to know that. The industry standard is actually to charge on committed capital, so it's kind of the way it is. So anyway, back to your question. What happens is when the venture capital firm finds a company that they want to invest in, let's say they want to make a $5 million investment in an early stage company, then they're going to go back to their limited partners, the people that signed those documents, and they're going to draw down the pro rata share from each of those investors to add up to that $5 million. And the mechanism they use to do that is usually an email or a phone call, and that's called a capital call. So they will call you and they'll say, you committed $1 million, we're ready to make an investment, and we need to have $50,000 of that $1 million in 10 days. Usually you get a week or two of time in order to send that money in. But when you sign the documents, you're committing to that full $1 million over the life of that investment fund, and you better be ready with the money to make that happen. A trap that a lot of families fall into is that things are looking rosy when they make the commitment, and then one thing leads to another. Maybe there's a financial crisis, maybe the family is buying some properties, or maybe there's something going on that reduces their liquidity, then they may have to really struggle to make those capital calls. The problem is if you fail to make a capital call, usually the legal documents of the venture capital firm have some very onerous penalties. You might lose your whole investment. You might have even some legal liabilities. So you have to be extremely careful to ensure that you can always carry out that $1 million obligation that you have through the life of that fund.
Right. Yeah, and I think that is a common misstep or something that's not watched as closely as maybe it needs to be by kind of mid to small size investors who are just starting to kind of dabble and invest in private equity. And some people have come to me asking for some guidance on kind of getting started in the private equity space, and this is something that I think often comes up in those conversations. When it comes from the side or the point of view of a private equity fund, could you explain the capital raising process that private equity fund goes through in gaining commitments? Because it's a little bit different than I think raising capital for a mutual fund or a hedge fund. Are you familiar with kind of the capital raising process that they go through?
Yes, I am.
Okay.
And I don't see that much of a distinction, except there's perhaps what you're reaching for is the concept of closings.
Right.
What happens with hedge fund or mutual fund, those are what we call evergreen funds. They're always open. You can put money in theoretically as long as the fund is, as long as the general partners are accepting capital. You can put money in September or October or November, whenever you like, and you just become part of the limited partnership base at that point. Venture capital and buyout funds are different. So are real estate funds. Those tend to be what's called closed-end funds, and they've got a limited life, usually probably average of 8 to 10 years, with the possibility to extend a couple times by a year or so. So usually 8 to 12 years. And what happens is they have a defined period for when they're going to raise money. So a venture capital firm may decide to start a new fund, and if they started that fund, that idea today, they might pick a date, let's say 12 months from now, early September 2012, and between now and the end of that period, they're going to accept capital. They're going to have a target amount, let's say $100 million or $200 million. These days, some of the funds are getting huge in the multiple billions of dollars. But the point is that they're going to try to raise that number. Let's say it's $200 million between now and 12 months from now. And they're going to have what's called closings. So they'll assemble a certain amount of potential investment capital, and in a few months, they'll have what's called their first close. Let's say you and I had a venture capital firm, we decided we're going to start one today. Maybe we'd have a first close in February, where we would take anything over, a conglomeration of 20 to 50 to $75 million, and we can capture that commitment there, sign documents, and our fund is off and running. And then we have the remaining months, the next end of September, before we do our what's called final close. I think the point you are reaching for, Richard, is that you have to make a decision before the final close, or else you just miss the boat and you can't participate in that fund.
Right, exactly. That's exactly what I wanted to get to, because I think that's something that investors need to understand. People that work in private equity funds or want to need to understand how that process works, just to kind of get a good feeling for how the industry kind of flows and grows in size,
Right.
based on investor interest.
There's another concept, Richard, that you probably have in mind to ask about.
Mhm.
It's called the J curve. Or
Mhm.
is that on your list of questions? It seems like this is a good time since we're covering some of the basics.
Yeah, let's jump into that.
Well, if you look at your hedge fund example, you put your money to work in this evergreen hedge fund, or you give it to the investment manager, and he or she will put it to work, and you'll start making money, hopefully, from day one. Of course, the hedge fund can always lose money because the market goes south, but in general, you're in with all the other limited partners in that hedge fund, and you're theoretically making money the same way they are. With a venture capital or buyout fund or real estate fund, there is a delay in their ability to make money. Imagine that we had our venture capital fund that we started a few minutes ago, Richard, you and I. We do our first closing in February, so we have some money to work with. Let's say we make our first investment in March. We invest $1 million of our $200 million in a company. That company is just an idea today. It's two guys in a garage. And it's going to take them a long time to take our $1 million, turn it into a business, finalize the development of their products, and start selling those products and start making money. So during that time, we're going to be losing money. We lost our $1 million, and we're not going to be getting that money back for a while. So if you looked at a chart that had on the just a regular XY coordinate chart with the left hand, the Y-axis being money invested or returned, and the X-axis, the horizontal axis, being time, then what we're going to find is that our investment returns dip below the surface a little bit when the firm makes that $1 million investment. Then we're going to invest in another company in April or June, and it's going to go lower down and lower down and continue to move to the right. I don't know if this visual is, if I'm helping you visualize this, Richard, but the point is that for the early days of that fund, almost certainly the fund's returns are going to be negative, and so that dips down. But over time, it turns around and starts to go up. The profits, as these companies go to market, as they start making money, as the venture capital firm starts to sell these companies or find financing at a higher valuation, the profits are going to go up. Pretty soon, it's going to go above zero. And then, hopefully, if it plays out the way you and I hope it will, Richard, it's going to accelerate up. And you can visualize in your head the letter J, right? Because we started at 0, it went down, looped down low, and started to come back up, and then hopefully goes far up to the right. So it's creating a J. And one of the things that people fail to recognize, in addition to the liquidity problem of committing that capital and having to have that capital available, is the fact that almost certainly they're going to be losing money for a while on that investment until it's what's called crosses the J curve. Does that make sense, Richard?
Yeah, that makes a lot of sense, and it was something that I forgot to write into my interview questions here, but I'm glad you brought it up, and it actually leads perfectly into my last question here, which I think is critical for investors, including family office wealth management firms and other institutional investors, to really understand. Is, inside of a portfolio you might allocate 20% or 5% to alternatives, or maybe much more depending on your outlook and what you prefer in terms of the types of returns. But if some people are not allocating to private equity yet and they're wondering, what's the selling point here? What is the real advantage of allocating to private equity versus stock markets through long only funds or hedge funds or hard assets such as real estate? Could you kind of give us kind of the selling point on why investors are consistently putting money in private equity? You kind of hinted at it earlier once or twice, but could you kind of give us the reason why people allocate to private equity in general?
Well, the reason it differs with each family. That's a very personal thing that has to do with their risk profile and their ambitions, their financial ambitions. The way I look at it is I consider traditional assets to be driven by compounding. And I attribute the main goal for traditional assets, meaning fixed income and public equity, and really a lot of the wealth management business is built around this notion. And that notion is capital preservation. You've heard the phrase, well, we've already won the lottery. We don't need to win the lottery again. Let's just make sure we take care of what we've got. And that forms the heart and soul of most family portfolios, and it should. The idea of keeping that principle, protecting it through diversification and smart investment, and then over time compounding those with market returns on the public equity side and debt repayment on the fixed income side. So very manageable, dispersed across the globe, and really focused on preservation. Private equity and real estate, especially the direct investing, but also the private funds, the notion there is to move beyond compounding and really generate new wealth to propel the family forward. Now, some families participate in the entrepreneurial process directly through operating companies, through operating real estate. So they're in it, they got the expertise, they're active, they've got people in the family working it, and they've got a high degree often of concentration in those entrepreneurial assets. That's how grandpa and grandma made their money in the first place, and a lot of families try to retain that entrepreneurial spark. Other families choose to invest and try to get those higher rewards through private equity funds. And that's really the role. It's capital creation. Of course, you want to have great risk management. You want to be very careful. You have to make sure you have the right resources to approach this and to analyze the funds. But the idea is that we've got a higher risk, but also higher return. Does that make sense? Does that answer your question, Richard?
Yeah, that makes sense. And I think that you brought up what I was kind of hoping would come up naturally is that, some families or some investors, and when we speak about families during this recording, if anybody is listening, family offices are really ultra high net worth wealth management firms for a single family or just a few families.
Right.
But I think that the important thing I was hoping that you'd bring up, and you did, was just that many investors are focused on capital preservation above all else, but a percentage of portfolios are often allocated to private equity to kind of produce a little bit of extra alpha, a little bit extra bang for their buck, and maybe they don't put all of their money in private equity. Some investors do, but very few put all of their money into it because of the J-curve concept and because of the types of returns that you see within private equity. But I think that kind of focusing on the fact that this is where new value can be created either directly within an operating business or through private equity investments that are more kind of long term in nature uh, is something really important for people to
I'm here.
understand. You know.
Richard,
Hmm.
I'm sorry, but the last 15 seconds or so cut out. I didn't
Oh,
hear you.
okay. Oh, no problem. Basically, the last bit that I was talking about was just that I think it's critical to understand why investors are consistently putting money in private equity. And I think it revolves around that fact that the core portfolio of most institutional investors is focused on capital preservation, but typically 3 to 7% on the low end, up to 35% plus is allocated towards alternative investments, which includes private equity because it can produce some great long term returns. They're kind of
Yeah,
outsized, but they take some time. So I think that was exactly what I was looking to kind of communicate or hoping that you would, communicate through your answer, and you did. So,
good. Thank you.
thanks for that. And we're
Yeah,
um, we're out of
There's
time today, but do you have something else you wanted to add to that?
Well, yeah, I just wanted to
Sure.
say one thing. There's some interesting contrast
Mm-hmm.
between the objectives of capital preservation and the objectives of the wealth creation assets. And if you like, I could just explain that in a
Sure.
moment, a little bit of time.
Sure.
Um, First of all, capital preservation should be and often is the core objective of the portfolio. And we would never argue at Featherstone that people should over allocate to the wealth creation strategies.
Mm-hmm.
If you think about wealth preservation, you're thinking about notions like I said, diversification, where you're finding several different strategies that are hopefully not correlated with one another, meaning if one goes down, perhaps the other one will go up and protect the principle of the investment portfolio. And so you have diversification and you're really looking at the downside and you're trying to capture the growth of the market. With private equity investing, you're going in a sense beyond that, and you're actually adopting concentration versus you're going to have some diversification, but it's going to be much more concentrated, and you're trying to create what's called alpha in the industry. In fact, what that means is you want to outperform the market and get returns that are much greater if you can. And in fact, it's interesting to think the word dispersion comes into play here. Dispersion of returns. If you look at the best fixed income manager versus the worst in the whole world, there's going to be relatively little bit of difference between the best and the worst. If you look at the best long-only public equity manager and the worst, there's going to be maybe a couple points of difference or a handful of percentage points of difference. But if you look at the best venture capital firm versus the worst, or the best real estate manager or buyout manager versus the worst, the spread from best to worst is much, much broader. And the best ones really tend to outperform the general markets at a much higher rate. So that's what people are going for when they invest in private equity. The troubling part is how do you find those high-performing partnerships to invest in?
Hmm. Hmm. Great. Yeah, that's something that I hadn't thought about bringing up, but that's an interesting point that I guess the skill or the process of selecting the managers is far more critical, possibly, than if you're looking for an ETF or an SMA long only manager. You can really either get outsized returns or outsized, losses or lack of returns, I guess, if
That's
you
right.
choose the wrong private equity fund, right?
That's right. And hedge funds, by the way, we haven't spoken about them as much in
Mm-hmm.
this conversation, but they're somewhere in the middle. The
Right.
dispersion of the best long-short hedge fund managers versus the worst is much more than the typical public equity manager or, for sure, fixed income manager. But generally speaking, the private equity managers have the broadest dispersion.
Right. Right. Okay. Great. Well, yeah, that pretty much fills up the time we have available today. But for anyone listening here, this has been Bradley Fisher from Featherstone Holdings. And Brad, I just want to thank you for your time here and sharing your knowledge on private equity. I think this is going to be useful to investors that are trying to allocate further to private equity, for financial analysts who are in charge of analyzing private equity, or maybe they soon will be in that type of role, so they need to get familiar this area. And I speak with many people who are familiar with the stock market and trading or investments, but they know almost nothing about how private equity works. So I think it's going to be really valuable for all those different types of groups And I just want to thank you again for all your time.
Well, it's been a real pleasure to talk to you, Richard. Thank you so much for the opportunity.
Great. I'll keep in touch. Have a great rest of your day.
Thank you. You too. Bye-bye.
Bye bye.